panel, Exits in Focus, which will highlight on the options for companies and investors looking for liquidity in the current situation. Let me invite on stage our panelists, Mr. Anirudh Agarwala, partner Trilegal, Mr. Mahesh Parshuraman, co-founder and partner Amicus Capital, Mr. Anirudh Dedia, principal at Chirate Ventures, Mr. Samir Kumar, MD and general partner Athera Ventures, Mr. Ramesh Kannan, partner Somerset Indus Capital Partners, Mr. Abhinandan, TS, managing director Veda Corporate Advisors. Let me introduce you to our moderator, Mr. Anirudh Agarwala, partner Trilegal. Anirudh is a partner at Trilegal in the corporate practice and specializes in mergers and acquisitions, private equity, and structured investments. Anirudh has advised on several high-profile mergers and acquisitions involving control, transactions, and minority investments in both publicly listed and private targets. He has worked with several leading funds and strategic investors on their investments and acquisitions in India and advised board and senior management of listed companies on internal investigations and corporate government matters. His experience of working on both private equity and structured finance transactions helps him find creative solutions to align the strategic interests of his clients with available transaction structures in complex regulatory environment. Over to you, Anirudh.
The same town. Sorry, that's on.
Hello. Yeah, thank you. So, thank you for attending this panel on exits and for being a part of this panel and being here. Right. I think we just want to kick off this chat with a general view of what you feel the market for exits look like in the next 12 to 16 months, right? And obviously there's a lot that's changed from where we were about 2 months ago to where we are today in terms of what the market's looking like, how the markets have responded to other stuff. So, you know, I think just this is a question open for the panel and you know, if you could also speak about your firms in that panel, that'd be great. But, you know, I'd leave it to you to get started on this, right? What each of you feel about how exits are going to be for the next 12 to 16 months. So you want to go, Mahesh?
Yeah, sure. Thank you. Maybe I'll start with an introduction to myself and the fund. I'm Mahesh Parshuraman, one of the co-founders and partners at Amicus Capital. We're an early growth fund that manages a little under 200 million right now. We are investing anywhere from 10 to 25 million across 4 sectors, which is healthcare, consumer, tech and financial services. Typically at the growth stage, I'd say Series B onwards, if I were to point to a stage. I think just to add to that, we look for capital efficient businesses that can go on to become category leaders in these 4 or 5 sectors that we typically invest in. Coming to exits, I think there's a lot of capital that's been raised in the last 2-3 years and deployed as well. And it's time for India to return capital back to LPs. So there's going to be a heightened focus on returning capital. LPs have only one question right now. Where is DPI, which means returns, which is really distributed to paid in, which means they just want money back so that they can put capital back into funds that are coming back. So I think you're going to see a lot of managers that are focusing on exits at a point in time when the markets are not easy. So valuations have definitely corrected. The silver lining in all of this is good companies that have stayed the course, managed the capital well, allocated well, that have good metrics. I think we'll find a lot more takers, and the ones that have misallocated capital, I think will struggle. So it's going to be a period where you're going to see extreme outcomes, where companies are going to fold up because they're not able to raise capital and investors will not make great returns. But at the same time, there'll be a rush of capital towards a few companies that have done well, because there is a lot of dry powder at the same time in the market. So I think I'll just end with that, and maybe you can hear from the other panelists as well.
So Amish, do you want to add? Sorry, Amish, do you want to add to that?
Yeah. Hi everyone. I'm Amish from Chirate Ventures. Thank you for getting me here, Team Venture Intelligence. From our perspective, Chirate is one of the largest early stage fund in the country. We have an AUM of $1.1 billion and a 16-year history across 6 funds. We've invested across 130 companies, and also thankfully, as he's speaking about exits, we've exited around 50 of them. So Touchwood has been a strong record of sorts in that sense. We are very early stage, so seed, pre-series A, series A, sometimes series B, across tech-enabled ventures, where tech has to be a disruption as a key parameter for us to consider investing and, supporting audacious entrepreneurs. Like some of the backers we have been Piyush Bansal of Lenskart, Super Maheshwari of First Cry, and 2 other ventures where, they've become big. And also Mukesh Bansal, first time we backed him when he was doing Myntra, second time during CultFit. So that's about us. As Mahesh also alluded to the fact that there is a lot of orientation on exits. So I have been hired in the firm specifically to look at exits. I was a banker for 15 odd years before this. And the idea is to see how, we as Chirate, of course, there's a great track record of exits, but how do we further expedite and enable and show to the world that yes, this country can deliver great outcomes. And of course, it's the largest growth market for everybody to look at, like across the world, given the issues around China and slow growth in Western part of the world. We are certainly the avenue for everybody to consider growth investing. But yes, if we back it further with a strong record of exits, this will further enable the growth in this country and support the innovation across the world. Like we, as a philosophy, our idea at early stage is to support a lot of innovation. So there may be failures, there may be some companies which may not do too well. That's fine. But at the end of it, there will be strong outcomes. And today, with the way this market is growing, there is a whole new depth which is coming in. We saw the first wave of IPOs. Of course, there was a tough journey, but I'm sure they will revive as one end. Second is M&As, and a lot of it is now going to come by in terms of exit. And third, which is a strong front, is going to be secondary exits, which, at least at Chirate, we have a good experience in. But as a country, now we are seeing both primary funds as well as secondary funds taking a lot of interest. Like the Lenskart deal where Abu Dhabi Investment Authority invested $500 million, a majority chunk of it was secondary. So here we are showing to the world that India is growing that scale, depth, and that ability to generate a good outcome where a large deal can be only secondary in nature. You don't have to wait for an IPO outcome or an M&A outcome for an exit to be delivered to the investors. So that's what I think. All positive, in terms of sentiment. Of course, things keep happening, but our 16-year journey has also shown us that, how do we navigate the curves and, enable outcomes at every stage, be it investing or be it exit. Thanks. Yeah.
That's lovely, Samir. So, from your perspective, how would you add to that or change that, or how would you think about it?
Sure. So let me introduce our firm and then myself, and then give you a perspective on exits. So I'm from Athera Venture Partners. We were formerly known as Inventus India. I've been with the firm since it was founded in 2006-07. Currently raising our 4th fund, from which we've started investing already. We are not prolific investors. We make 3 to 5 investments a year. So over the last 16 years, we made 38 investments in India. And we are tech focused, but since we also invest in the consumer space, some of our consumer bets are probably better known. We were early investors in Redbus, which was a very good outcome for us. We were early investors in Policy Bazaar, which listed about 18, 20 months ago. We've been early investors in Healthify Me, which we share with Chirate, and many other B2C firms, but we are also B2B investors. And over the last few years, we've also started investing in what we call emerging technologies. So we've got a 3-wheeler electric vehicle manufacturing company called Euler Motors. We've got a hyperspectral satellite imaging company called Pixel, which is actually making satellites and sending them into space. We have a smart helmet company called Blue Armor, which is actually smartifying helmets to give you all sorts of things, features, aspects, connectivity that you couldn't get before. We did a toy company, again, Chirate is there, Play Shifu, which is smart toys. So these are some of what we call the emerging sectors. And we'll continue to look at B2B SaaS, consumer internet, and emerging technologies from our fourth fund. So in terms of exits, I think Mahesh and Amish have covered a lot of things. The only thing I'll add is what I've been very heartened by in the last few weeks. Yes, we saw a plethora of IPOs in 2021, including one of our own companies, Policy Bazaar, and we saw almost all these IPOs go underwater, and probably most of them, if not all, are still underwater from the price at which they IPO'd. I think we saw there a bunch of companies that promised profitability in the future. And knowing Policy Bazaar intimately, it is a company that's already on that path. It's going to be profitable extremely soon. I have bought only one share on the stock market in my whole life. I mean, people say you're in the investing business, what a fool you are. And that share is Policy Bazaar. So I have that much confidence in this company. But what I'm very heartened about is the IdeaForge IPO, which happened in the last 10 days. And the reason I'm heartened is that it tells you that the market still has appetite for well-run companies, like Mahesh said, that have not misallocated capital, that have focused on delivering value to their customers. And to me, the measure that you have delivered value to the customer is that if it costs you X to make something, you're able to realize Y, and Y is greater than X. If Y is less than X, which we see in a lot of companies, then I'm not sure that you're delivering value. You may be delivering value, but I'm not sure. So what I'm very heartened about is the IdeaForge IPO. Yes, it's a tough journey for them. They've been around for 16 years. People are questioning, the cash flow, the numbers, the this, the that, working capital, and all that stuff. But to list in this environment, to get a 95% bump up on your listing price when you actually list is something I'm heartened about, and largely because they're profitable. And to conclude, if there are entrepreneurs in this room who are building companies that are built to be sustainable, where profit is one of the things they look at quite seriously. It's not that profits will come, or don't ask me about profits. That's what some of our IPO entrepreneurs said in 2021. I think there is enough exit opportunity for all of them.
Thanks, Amir, super helpful. So I think at this point, Ramesh, do you want to add something to that first? Maybe talk a little about how Somerset works in a specific sector and how, say, exits are different in that sector.
Yeah. Now, basically, I'm Kannan Ramesh, senior partner at Somerset Indus. We are a very focused, dedicated healthcare fund only. Compared to all my illustrious panelists, we are small, focused, but because we are small and focused, maybe we are effective. We have a 100% track record in exits. I think that is a situation we are very proud of. At the point of investment, honestly, the only aspect we spend a lot of time is the potential exit. We never want to be in conflict with the promoter. He is told very clearly, because we are the first institutional investor. So very clearly he's told this could be the potential investment exit opportunities. Typically, like Cygnus Hospitals where we invested very early, we have a term sheet now for exit from two very, very large private equity players. We went public with Krishna. So everything you look at, we at the beginning itself know very clearly what should be the exit process. We are today, thanks to our effective track record, able to get a lot of co-investments. So size is not an issue, and we are able to bring in more investors. Like one of the companies they have invested called Genworks Health. We have put more than $30 million. We have got other investors coming in along with us. So what it tells you is, we don't rush into a deal. We are no hurry. We invest in people, not in business. We want to make sure we get the right people. Second thing, most important from an exit perspective is, what are you building? If you look at our fund two structure, there are about 3 hospitals, 2 hospitals, 3 pharma companies. 2 of them are in API, which is a hot issue today. So ultimately, if we are able to put everything together, in fact 3 pharma, sorry, if we are able to put everything together, you create a platform network, thereby getting in more capital later should not be an issue. So I would personally believe that we should be very focused on the exit potential, create the right opportunity. We work very, very closely with the portfolio companies, almost on a daily basis. We get them a lot of network connects. We acquire companies for them. So ultimately, if you do all this right and pick up the right people, particularly being a private equity compared to a lot of VC, I think success cannot elude us in any way. So I have to be careful, cautious, conservative, but very focused. That I think yields results. So ultimately for us, from experience, we had no issues on exit because both the promoters and us are absolutely clear what should we do in the next 5 years before we step out and somebody steps in. Last but not the least, in healthcare in particular, in the last 2 years we can see a lot of mergers and acquisition happening. A lot of big hospitals, etc., are acquiring to become regional czars. Honestly, there is no pan-India player. Advertising is all not there. You become a regional power play, and that is what is happening today. So in the future, like Temasek acquired Manipal, she has acquired Medica, etc., there will be a lot of consolidation and ultimately leading to IPO. We believe that 3 of our companies can go IPO and working towards it. Net, I think clarity is what brings everything to the fore.
Thank you. So Abhinandan, just you want to take it from there in terms of how you look at it as Veda?
Yeah, sure. So just as a quick introduction, Veda is a firm that's been around for 20 years. I think the first 15 years we were a very traditional private equity focused firm, and in the last 5 years we do both traditional private equity M&As and also quite a lot in New Age. We did about 40 odd New Age deals in series A, B, C and above. So just to give a perspective on both the sides, right? In terms of the New Age companies, the last couple of years there's been tremendous amount of capital that's gone. There've been quite a lot with very robust, solid business models where there's an end focus which is self-sustainability and not just dependent on next set of funds. Those companies we see continuing to do well, continuing to raise money even in today's market, and quite a lot of firms that took a lot of capital without a very solid business model and a lot of burn are kind of merging into others at a lot of distressed deals these days in the market on the New Age side. On the traditional side, again, it continues to do well. The India theme is quite big. What we are seeing off late, especially in exits, there have been a bunch of, I would say, global investors as well as global strategics, right? Whether it's European, US, many wanting to enter India, which shows that this is the market that is growing. A very recent transaction where we are running something in the vaccine space, we got within like 2 months about 5 offers from Europeans, right? And all of them large listed public companies, their stocks beaten down by 40-50%, but still kind of coming in at very premium valuations here. So the key takeaway I feel is that from an India perspective, self-sufficient market it's quite good still. And once the basic fundamentals in terms of growth, sustainability, profitability is there, the options of exit are quite a lot, both from secondary, both from global strategics, as well as quite a lot of domestic funds.
Great. So, so in that sense, I think maybe I'll move on to the next piece of the question, right? So so for example, Mahesh, when you look at, what is it that you look at when you look at founders who have like given you delivered good exits, right? So when you evaluate founders, what is it that you're looking for? And from a history standpoint, what is it that you feel is the characteristics that given you a good exit?
Characteristics of the founder. I don't think there are any.
Yeah.
Okay.
Maybe you can.
It's working now.
It's okay. Okay, is it clear now? Yeah, okay. So in terms of characteristics, I think it's to do with not just the founder alone, but the business in itself. I think over time we have seen that good founders always deliver good exits. I think that's one thing that Ramesh alluded to as well. I think backing a good founder is very important. So there's a lot of time that we spend on founder selection in the first place. I think the good part is in an exit, I think it's very important for the founder also to know when the investor is going to exit. And I think that clarity is quite important. So as an investor, I think apart from expecting the investor to, the company to deliver an exit for you, you also need to work closely with them to enable it. It can't be a one-way process where you just wake up at the end of 4 or 5 years and say, I need to exit. So I think providing that clarity of what your typical hold periods are, giving them advance notice, helping the portfolio companies work towards that exit, making sure that the metrics are in place is a two-way process. So I think it's a collaborative approach. I think the responsibility that we as investors have is to make sure that the capital is allocated well and that they take a long-term view. I think if I look back at my own journey of 20 years, cap tables have changed dramatically. There were periods of time when you had just one investor and 2 investors. So it was a lot easier for you to steer a company in a certain direction. Today you have lots of people at the cap table and each one has differing objectives, outcomes, hold period. And I think for you to get a good exit, you need to make sure that the founder is focused on doing the right things for the business rather than just focus on exit, because that is a very short-term approach. Markets can change, the buyer's mindset can change, but if you have a good business, you can exit. So I think aligning as an investor, and making sure that we can convince the founder to look at what is good for the business is important, and prepare well in advance. I don't think you can wake up one day and say, I'm going to exit. It's a good 6 to 12 month process.
Yeah.
And plan well in advance, let the founder know. Good teams, good businesses, capital efficient businesses always deliver good exits. So I think it is to do with a bunch of these.
Yeah, great. So Amish, when do you think exit planning begins for you, right? Does it start when you are investing? Does it start once a certain cycle is reached? Where in your in a fund life do you think is the right time, or investment cycle do you think is the right time for you to start thinking about exits?
So let me address it first. Am I audible?
No.
Hello?
Excuse me.
Yeah, cool. Thanks. So let me give an answer from the industry perspective. It's okay, right?
No, I don't think it's on.
I'm getting thumbs up. So yeah. And the good part is, thumbs up is also showing that people are listening. Thank you. Cheers.
Yeah.
So one thing, let me cover from industry perspective and then I'll come to Chirate. See, there are different natures of funds. We are early stage. They are slightly growth, they are growth, early. So funds of different nature have a different perspective on exit. And the visibility, as you rightly asked, where is the visibility of exit? Maybe a late stage or growth stage fund will have slightly higher visibility as against an early stage guy. Like for example, some of the large tech firms, we notice, right, that every few years there'll be a change in ownership. One fund is buying, the other is selling, etc. Or around a listing process of sorts. We come in very early, the VC industry as a large, right? And many of the businesses pivot in the journey. You may have invested in something, but as the forum unanimously said, actually it is about backing the right person, right? And the person is agile enough, markets make him change business. Similarly, we also have to be agile and aware of the situation, support the company in its journey, and then accordingly have a very focused strategy of reviewing business along with the founder, taking a consensus-driven view, and then figuring out what the exit mode could be. For some guy, if there's a negative headwind and he may have to, let's say, have an option, okay, of not being able to go to that leg of IPO or, a master stroke of sorts, then maybe enable an M&A for them, right? And be supportive. Work with the founder. Make him realize, as he rightly said, that, he also has to realize value. And for his firm to survive when there's no capital, can he look at a larger player who can take it under the ambit, right? So agility is important for a VC. There could be slightly more certain exit options for guys who are at certain late stage. For us, as I spoke earlier, that we have to support a lot of innovation. We are supporting right guys, but ideas may keep evolving. Like even the lens card in its first journey was 4 different cards, jewel card, back card, etc., etc. Then he became lens card, right? Even one of the most profitable companies in India today in terms of, their growth and their profit orientation, this is how pivots happen, right? Coming to the nature of exit, generally it is M&A, IPO, and secondary. And as I said, secondary again in 2 forms. It could be mainstream funds or a secondary fund of that nature. And we can talk about it more. So what many funds do, as Mahesh also said, that prepare the founder over the journey and then let that outcome happen. So many funds wait for, the company to grow and then realize full value at one go, which is, let's say, towards the end of, let's say 5-7 year horizon. Some of the funds, and including us, we follow a slightly different approach. We have a slightly more different orientation of disciplining exits at regular intervals. We will keep selling stake into companies at regular intervals, mainly along with the primary round happening, okay? And of course, it's all in consensus with the founder. We are always, talking to him and apprising him ahead of time that this is our intent. And if there is adequate demand and supply situation, then we will participate in that kind of an exit. What it helps us in 2 folds. A, it helps us return money to our LPs on a very regular basis. This is one discipline that our LPs like, and possibly, one of the reasons that we've been surviving for 16 years today, right, in this journey in India. Second, it also helps us sometimes hedge against the possible downside because we come in at an early stage. And there could be situations at macro level, be it a COVID, be it a regulatory change, be it innovation in the industry, which can, turn the table down for a certain type of an investment which we would have made earlier. So it helps us hedge in that situation also, because we've seen in India, right, some companies would have gone up and come down, etc. So these cycles may not be predicted, as I again said, at an early stage venture. So this is what we as a fund do, and many others are also practicing in terms of exit. And in terms of our visibility, whenever we start an investment, of course, there is an exit hypothesis, okay? And given the experience, we may be able to predict that, okay, this company would be more amenable to an M&A, this will be for an IPO. So we make a plan, but as we progress in the journey, we regularly keep reviewing the portfolio and then taking a call what has to be done at every stage in time, right? So that's what I think we would do here. Thanks.
No, that's very helpful insight. So we're just taking on from there. Do you feel that the perennial question that people ask when they talk about VCs and exits is that what should the founder focus be? Right? Is it delivering metrics? Is it delivering performance? Or is it creating an exit for the investor? Right? So where do you stand on that, and what do you think about what the best way for a founder to be is?
I'm very clear where we stand, and I think I articulated that. The founder has to build a viable, sustainable business for the long term. Exits happen.
That's short and sweet. I think, so then just moving on to Ramesh, right? So, you know, Ramesh, given that your fund is so focused on healthcare and life sciences, right? And that's obviously a very deep industry and lots of opportunity there. But from your point of view, do you see that differently from how general PE VC investors look at it? Is that sector something specific that has something specific from an exit standpoint that you would like to?
Yeah, there is a sense of difference in the sense that we differentiate between healthcare and health tech. Health tech is a different ball game. We have seen a lot of proposal. We still believe that it has not come to age. Healthcare is more conservative, traditional, and has a huge potential to grow with newer areas of interest. You could diversify, you could acquire, you could grow beyond the country. So a lot of opportunities exist. But one thing very, very important in healthcare is, maybe it is true in other cases also, I don't know, you are dealing with people. And in healthcare, it is doctors. Ultimately, when you invest and want to exit, we have to be very clear what the doctor wants. There is a clinical area, there is a management area, and then there is ownership. What does he want? He wants to sell, he wants to continue, he wants to give up management but wants to be in clinical. That I think is very, very important for us. We don't want to do anything in conflict with the promoter aspiration because we believe every doctor matters to the society and we cannot afford to basically get into a conflict with them. So basically, health tech is a different ball game. That will take time to mature. We continuously look at proposals, but scale and size has still not come in. Healthcare, a lot of developments are there, particularly in pharmacy, life sciences, as I was saying. A lot of API is the latest flavor. India wants to be self-reliant, so a lot of PLI schemes back API plants is something which everyone wants to come in. We have done 2 already, and in Fund 3, we want to do more. Basically, our thesis is that there is a huge business opportunity in Tier 2 and Tier 3 cities. That is where every single portfolio company has a market, and we have demonstrated with metrics, ESG norms, etc. The place to be is Tier 2 and Tier 3, not the main cities at all. Be it diagnostic, be it lab, be it home care, be it hospitals, be it pharma, be it formulation. I think there is a huge market. Rest of the world is a big market. Middle East and Africa is a big market. So ultimately, there is no paucity of good potential. The issue is, I am the first investor. I could bring in any amount in Fund 3. We can put up to 25 million on our own. We can get co-investors. So money is not an issue. The thing is, do you have a vision? Like he said rightly, we are a growth capital focused. We don't look at the same lens like a seed stage company looks at. Our approach is very different. We line up opportunities for that company to acquire smaller companies. We've already done many acquisitions for our industry companies. We set up overseas entities. We bring in global network into directorship. So at the end of the day, healthcare is sensitive. We have to treat it with empathy, and ultimately you are dealing with people. Very important that you are seen to be somebody enabling the good for all than pure economics. I think for us, economics plus empathy, I think is a greater achievement than purely looking at only economic. That is why in the Fund 3, as we can see, lot of DFIs, development finance institutions, wants to back us. Big way, because they see here is a fund focused on Indian entrepreneur, focused on Tier 2 and Tier 3, doing healthcare, not health tech, and supporting initiatives which can benefit the country at large.
Thank you. That's super helpful insight. I think just based on that, I think maybe just to add a lawyer's perspective, right? I think what we've seen consistently over a number of transactions that we do, right, is the market is changing from where it was in the past, where you know most deals were private equity buyouts of of companies, to now private equity backed buyouts of other private equities, venture capital exits to other funds. There's a lot of family wealth offices which have come up, which are also investing and giving exits, right? So, Abhinandan, I think you deal a lot with all of that profile, right? So, from your perspective, how does the transaction change, or how do you see PE and VC investors on the sell side and obviously on the buyout side?
Yeah. See, since we do a lot of Series B and C, we encounter this almost in every case, right? At Series A, investors come maybe 2 years earlier, B comes immediately 2 years later, then a C comes. Each one has a different exit horizon, each one has a different fund life. And in this entire journey, the markets change, new products come up. In the last few years, we've seen so much structured credit products being used for exits, right? But the fundamental thing is, at the end of the day, when anyone enters or exits, the rights and the exit obligations and all the other parameters for everyone needs to be made very clear, right? And in the boardroom, whether it's the Series A, B, C investor or the promoter, there should be a dialogue, because let's say you're looking to exit in say 5 years, and 3 years something really amazing comes up, a new product which no one exited. Is the board open to discussing it openly? So what we try and do, at least as a firm, when we do Series B and C, is, given the lot of situations that we have seen in the past, try to kind of cover the pros, cons, the ifs and whatever could happen during this journey, so that a lot of things are sorted up front, and when it comes to exit, it becomes smooth and everyone's discussing with an open mind.
Okay, so perfect. I think just maybe just a general question for the panel, right? So when it comes to exits, obviously one of the biggest challenges has been, and especially when it comes to your own exits or what you're buying, has been the package of rights that you have to offer, right? For LP-based funds, LP-backed funds. It's always a tough conversation to have, and at least we are seeing a lot of uptake in reps and warranties insurance in the market, right? Is that something that you're also seeing in terms of size, or are you like, when you're on the buyout side, are you willing to take higher risk in terms of the fact that, you know, private equity backed companies are likely to be more well run as opposed to founder companies in the past which needed a whole host of reps and warranties, right? So I think just generally for the panel, whoever wants to add to it, what do you feel about that, and where are you on that?
Maybe I'll take a quick stab, because we are in the middle of 2 exits right now, and this is the hot topic in both of them. So I wish it was the fact that people thought that venture-backed or private equity-backed companies are well-run. We've not had any governance issues in any of our companies. But I think given what's happened in the environment as far as governance is concerned, there is a lot of concern in the minds of buyers as far as what your oversight on your company has been. You may have been a board member and so on and so forth, but I think that level of jitteriness that has come in now, I haven't seen it 10 years ago when we exited Redbus, let's say, or some of those other companies. So that's clearly what I would like to say is it's created one obstacle in the exit journey. It's not that exits are not happening because of that, but points that you made. We didn't take reps and warranties insurance. Reps and warranties were very minor on fundamental reps and warranties, whether it was Redbus, Socrates, and so on and so forth. Now people are asking for much more deeper, stronger reps warranties, and that delays the process. But having said that, I think buyers do their own due diligence. And just like all of us said, we back entrepreneurs, right? We are backing people, and then businesses come after that. A good entrepreneur will need to pivot, at least at the stage in which we come in. Very unlikely that, you know, this was my business plan and that's where I exited. I think buyers are also now getting their own feel of the entrepreneur. And if they think that entrepreneur is honest, decent, grounded, etc., their jitteriness comes down and some of these negotiations become easier. That would be my take.
Do you want to add anything else?
Reps and warranties insurance, I think, has been around for a while.
Yeah.
While I know it's gaining some traction,
Yeah.
I think there are too many caveats still, right? For example, you take transfer pricing, you don't get a rep and R&W insurance. So I think that product also needs to evolve. And I think it's a little bit of a chicken and egg situation where someone needs to take it and then go through the life cycle. I think there's no enough mass for it, so it's priced a little higher than what it would get priced elsewhere globally. So I think there are a bunch of questions out there. But what will happen, in my view, is this as a product will take off given the amount of capital being raised by a lot of funds. And interestingly, what is happening is the LPs have clauses in agreements on give back. And LP give back clauses are, the periods are all shrinking. And our indemnity starts from, tax indemnity used to be 7-8 years. Now people are saying 10-11 years. So clearly, I think there will be a point of time when managers or investors will need to look at it and say, you know what, I need to stop the clock and take a practical call. I feel that a lot of those things are coming together in this cycle. If you ask me, maybe 2 years from now, you will see a lot more of, reps and warranties insurance that will come in different forms. It also depends on whether you've been a minority investor, whether you've been a control investor, whether you played a active role in the management. So I think a bunch of issues to consider there, but I think that you will see more and more traction given the push from the LP side on smaller givebacks and need for managers to achieve finality without having to dip into the carry pool or the profit pool or whatever it is.
Yeah, great. I think, and just, maybe pivoting a little, I think the other thing globally, which is a trend, which is like R&W insurance, right? I think 10 years ago, almost all US deals were happening with R&W insurance, but it's picking up now in India. I think the other thing we are seeing a lot globally is continuation funds, secondary vehicles, right? Entities doing portfolio transactions with other groups, right? And obviously we've had one in India recently, and that's been in the news. But what do you think about exits from secondaries in terms of GP-led transactions and how the market is for that?
Can I take this? So in India, what has happened historically from secondary funds, there have been limited funds who've been having on-ground presence, and the trades earlier were where funds were reaching possibly end of life and selling stake to a secondary fund just because they had to return the amount to the LP. And but now this GP-led as a new concept is coming in India. It has always been there globally. Maybe it's, I think 50% of the market globally is all GP-led. And here the way I understand the concept is that the manager gets the opportunity to continue its investment in the company. The new incoming secondary investor would give an exit to the existing LPs here. Now pricing could be a question, that is where a lot of thinking and evaluation on both fronts will come in by the incoming guy and the guy who's getting out, because there is possibility of leaving an upside on table, which is the lure for the incoming guy as well, right? So given this trade-off, there is a huge market potential coming in. A lot of global funds I am interacting with are all looking at India today because, as I said earlier, this is the market of growth and the depth is increasing. So they have a view that within 5-6 years, if we are able to stay invested in certain companies, we will be able to reap the benefit, and we as the general partners will also get a benefit maybe now when we are giving liquidity to our existing LPs, and also monetize when the eventual exit of this guy happens, right, the new incoming guy. So there are conversations I think the country is now seeing, and I'm sure from your side all of you would also be witnessing. But this is one new breed of exit which is going to see a lot of traction and focus in India going ahead, I believe. Because not every company may want to, as the depth increases, not everybody may want to do an M&A, not everybody may want to go listed, okay. So I think this is coming as a very fair and good alternative, and I think this is where the action in this part of the world will be, I believe, yeah. Thanks.
So, Samir, you want to add something?
No, I don't want to add. Should we just see the
Yeah. Are there any questions for the panel in that sense? Yeah. Now that. So if you could just show your hands, I think they'll get the mic to you. I think there.
Hi. Yeah. Can you hear me? Yeah. Hi. Hi, my name is Sanjay Shukla. I am from San Angels. So I heard about these exits and secondary sale of 500 millions and millions of dollars. I'm a little bit about the individual investor, angel investor who is investing 5 lakh, 10 lakh rupees. I think there is a huge potential is there as like mutual fund is now, I think it's come of age kind of thing and a lot of people are investing. Same thing is going to happen in 4 or 5 years time with the startup ecosystem also. And there is a huge issue is our secondary sale is there. So any thoughts around that, how it can be solved? Thank you.
Sorry. So just to confirm that question, right? You mean like for small investors, what's the best way
secondary sale opportunities, no?
For angel investors, what's the secondary sale opportunity? Yeah. Sorry.
So I think incoming investors.
Yeah, I think it's typically solved in the subsequent rounds. Most often what happens is that when the round gets larger and you move from Series B, C, it is always better for the incoming investor to have a cleaner cap table so that you can align the exit to a common goal or at least not the exit, I mean the business to a common outcome or in a certain direction. So typically exits for the angel investors in my view are the least of the concerns because that gets taken out in at least in most of the companies that we've seen because it just allows you an cleaner exit, get a cap table that is aligned to a common goal, and that's really what happens. And I think that I see that happening organically. So as against, and they're also smaller amounts. So typically what happens is that the primary investments are much larger and the quantums that is paid out to an angel investor just in terms of absolute amounts are not very large relative to that round size. So there's always some space that is made out for either ESOPs, for angel investors, or maybe the earlier seed rounds.
Yeah, I think that's a typical way it happens typically. But more and more I see where angel investors are looking to sometime do a secondary sale and there is no opportunity for them because for them also a buyer also is very difficult to judge what kind of company is this because founders are not going to be there pitching for that secondary investor. So there is whole market is there which is not explored and there is an opportunity. If that opportunity is there, probably this market grow 10-fold, 15-fold from the secondary, from the smaller investors perspective, no? And right now I think that's kind of missing.
Just a quick one here. I think it's a very valid point and that depth will also come in and it will enhance the flow, because liquidity, like in mutual fund, as you rightly said, there's liquidity, there's more investment, right? So in certain pockets of the country, there are some individuals who are coming up with professional organizations which are enabling secondary trades at a small angel level, okay? So you may want to explore, they are yet to grow of size and might, but these platforms are coming in, some are getting funded, some are not, but I think over the next 1 or 2 years, we will see visibility of that happening more and more. And of course, as you said, the best is to talk to the founder for him to enable things for you. But these platforms are going to be very active. They are there many globally. And I'm sure India will also see in the next couple of years. Yeah.
Thank you.
At the back.
Hi, this is Tejas from Capita. So one of the answers that you just talked about, so we do that in India. But I wanted to talk about the ESOPs piece, right? Which is largely the 4 or 5 year vested ones. And they're not really anybody kind of, even the buybacks that you're talking about is not so frequent, right? About 440 million last year. And I think that's close to about 10 billion or even more than that. At least what we manage is about 10 billion ESOPs vested. But there are no funds. There are some secondary funds that are entering right now, PEG and others. What is your take about that?
I think the mic was a little poor. Can you just repeat the question?
Okay, so basically ESOP liquidity. What is the solution?
So can I answer that?
Yeah, absolutely.
See,
if we are sitting as investors in a company, then we don't want too many transactions to keep happening. So the answer to Sanjay Shukla's question also, whether secondary sales can happen, these are not listed companies, and it's an overhead on the company, and especially a small startup, to keep doing share transfers, getting new people on the cap table and all that. So typically angel, and I'll come to your question, typically angels should look for an exit when a round happens and not just in between selling to somebody else. That is my point of view. In my company, I would be quite obstinate about that. But on ESOPs, answer is very similar. Employees should not look to sell at any point in time. But whenever the company exits, or whenever it goes IPO, or whenever an M&A is happening, even if it's a partial M&A, most entrepreneurs try and make sure that the ESOP holders also get some liquidity, if not all. It's a function of the entrepreneur, and at least in my experience, most of them have tried to ensure that.
Yeah, and I think just on ESOPs alone, I think when we advise startups on putting together ESOPs, that's one of the things we actually highlight, that the quality of an ESOP can depend on how well a ESOP holder can actually participate in an exit. So if you give them the right to participate in a change of control, that's a much more attractive ESOP for an employee than just not having it at all, right? So I think when you're looking at your ESOP, it's good to see whether you can participate in larger transaction, because for an ESOP holder also, that's the best time to take value, as opposed to trying to sell in the middle.
Actually, I'm going to make a controversial statement here on this bit. Okay, I think one of the big things, at least as a fund, that we look for is alignment of interest in any investment that you've done, that you make or we make. I think the last few years of lots of capital being available, I think has just misaligned the market. So not to, I think employees need exit, it's all good, ESOPs need to be liquidated because but they need to be liquidated at various points in time when value is being created. If you try to do this in between, I think it just creates a misalignment between employees, founders, and the investors. We are all working towards a common goal of creating value for all stakeholders. What is good for an incoming investor is good for the employee, right? And that's really what we would like to stick to. I think there's a perverse incentive in trying to, create this midterm liquidity, try to put 20 million. How do you give a founder 400 million of exit and expect him to come to office and work for your investors? I mean, it ain't going to happen, right? So I think it's a problem in my view, right? It's great to say that I want to keep my employees happy. Yes, I want to do that, but I want to do that when I create value for myself. I will also make sure that I create value for you, and I'll give you an opportunity to create space in the round for liquidity to happen, not otherwise.
Yeah,
I couldn't agree more with Mahesh.
So, I mean, I was also referring to the non-promoter ones, essentially the vesting ones, basically because that's one of the key things that many people have been given today. And 4-5 years, I know so many people in large companies that are very well funded and are not able to exit. The non-promoters, typically a CTO, and those kind of guys. So I think the problem still remains is what I was suggesting.
Look, I think it'll be very difficult for me to comment on something else, but I think we'll probably stick to our experiences. And I think in most of our companies that we've funded, alongside a round, we've created some liquidity. That is calibrated, and rightly so, because you really don't want someone who's come in 6 months back to take value, but you really want someone who's been there since the beginning, who's worked to build a company to where it is today, to take some money off the table. I think that those are good things. So at least that's really what we believe in, and make sure that we create space in our companies.
Thank you.
I think we can take one more question.
Hi, I'm Deepak again from Veda Corp. Can you hear me? Yeah. So this question is more to the early stage funds. Like when you back a founder, like you just explained, and he's trying to unlock the value and going through pivots. If you have like some co-investors or other funds in the cap table which have a shorter duration, or maybe the company goes through a down round or something, I just wanted to ask you, like, in your experience, or how do you deal with such situations when you have to motivate the founder, or keep a positive environment in the company and the employees, etc. So how do you deal with situations where you have to, either revive a company or enable him to give some more time to unlock his real value or go through another pivot?
Early stage, so.
Should I go? So your question is, how do we as investors motivate the entrepreneur if he is going through a down round? Is that your question?
Yeah, or if the market is still not matured, like something like traditional healthcare. So how do you keep supporting the investor if the company went through a valuation cut by another co-investor or went through a down round and things like that?
I haven't followed the question.
So again, just to repeat myself, as early stage investors, how do you back the founder when any other co-invested fund or...
Okay, so let me just answer it in two parts. How do you back the founder when a next round is happening, and how do you back the founder if it's a down round, which is the next round? So as early stage investors, speaking for ourselves, and I'm sure Chirate has the same because we have many investments with them, for every rupee we invest in the round that we come in, we keep 1.5 rupees reserved for the subsequent rounds. So we typically come in Series A, we put in money in Series B and sometimes in Series C as well. So that's the support we show to the entrepreneur. Obviously, we have to have confidence in his vision and plan and so on and so forth. Now, when down rounds happen, it's a tough situation, and down rounds do happen, and especially in today's environment, a lot of down rounds are happening. We then work with the incoming investor who's doing the down round, with the entrepreneurs, and very often we create a pool. It could be a performance-led pool for the entrepreneur saying, if your company reaches these milestones, we will give you so much of ESOP, diluting ourselves to make sure that you have a reasonable stake in the company. At the end of the day, almost all of us, and I can speak for everyone here, is guided by the principle that if the founder does not have enough skin in the game, sufficient value will not be created for the investors.
Fair, got it.
So,
Hi, myself Rajesh Bang from Abhar Corporate Services, Gurgaon. One typically, as an advisory firm, we have come across that the funding was taken from a private equity fund. 5 years are about to finish, and there is a pressure to either get an exit through an IPO, and the markets are not really very well. At that time, he's being forced either to get into an AIF situation or have a bridge, which again needs some time. So as investors, do you feel that because right now the journey is difficult current ecosystem, so do you feel that how to really get that time for the promoter or the founder to really get the value to you also on the table and for himself also?
See, basically, it all depends whether the founder requires a higher runway, more runway than currently available, so that both he and the investor are benefited. Now the issue is there are a lot of new instruments which are basically funding structured manner where you can buy out the existing investor, give a 2-year moratorium for principal and interest, and then work out an exit strategy. So in the last couple of years, a lot of new innovative solutions have come up where exits are not a real challenge that way. If like Mahesh keeps on repeating, it's a good company, there will be a lot of people willing to provide that additional runway, which can benefit both the people. No issues on that, I think.
But I don't think so. There is a set of pool of investors or fund managers who are trying to build this gap right now, right? Provide a runway of 2 to 3 years at the last lot.
No, there are venture debt companies today, debt companies,
Okay.
lot of acquisition financing companies, etc., who will step in the shoes. If the investor has to exit for reasons best known to him, they will step in, buy him out, keep the thing going with a structured plan, They don't burden the company with interest per se, but in less than 2 years, a next round happens and a secondary cum primary happens, then the guy who stepped in exits. It is possible. I have done a couple of deals on those lines.
Thank you, sir. Thank you. Thanks.
Hello. Yeah. Thank you so much to the panelists for this discussion and thank you for the questions. So we are around. So if anything else you want to have us chat with, please feel free to reach out to them. Thank you.
All the panelists for such an insightful session. I request you all to come forward for a group picture. The audience can head out for a short networking break and be back in by 4 for our last and final VC panel. Capitalists will throw light on the future of VC investments.